Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about the status of the stock market, Disney's earnings, and the projected 2023 Social Security cost of living adjustment. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. After yesterday's inflation number, the market initially ran higher before rolling over and ending up down on the day. What's your take on this action?
Well, good morning, Allison. Thank you for that intro. And let me get out of this. Here we go. So another rough day in the market, right? So not what I expected, right? So we had, if you roll back earlier in the week, we'd made the pass the ammo kind of thing. Some new money's rolling in. I put that to work. And then yesterday we had a terrible inflation number. There's also another bad inflation number out this morning that's leading to the futures being in the red. So overall, we took a hit yesterday after the market initially celebrated for some reason, went up after the inflation number, like maybe peak inflation is behind us. Many pundits were pointing out, like I did yesterday, that this is an April print and the half basis point raise happened in May. I don't think anybody really cares about that for some reason. So here we go. Inflation fears are taking the market down again today. When you look at the S&P 500, we'll pull that up. The 1-year chart, obviously, we're back below where we were a year ago. If you look at the 5-year, so this is what I want to say today, and this is worth visiting from time to time, is that, if you've been invested for the past 5 years, you've made a lot of money, right? You're down from the peak. Obviously, there's no way to sugarcoat that, but these do happen. When you look at the sell-off at the end of 2018, you look at the 2022 sell-off, each time market sells off, revalues everything, and then the market goes back higher. You would have to have a literal end of the world, end of the United States scenario to think that that's not going to happen again, right? So these are the times that try investors' souls, if you will. Hang in there, hold the line, if you will. Year-to-date change, I dare say only 18% in the SPY. Obviously, if you're invested in tech, it's much more brutal than that, into the mid to upper 20s now. But yeah, keep things in perspective. Look at these dips of the past. This was an interest rate dip in 2018, at the end of 2018. This was COVID. And then now we have another interest rate dip this time, from, when I say interest rate dip, market dipping, because we're raising interest rates. So hang in there. I do think today stays in the red. I do think we are in the bathtub, though. So new money that's coming in, I'm immediately putting it to work with our bear market strategy, which is only focus on the absolute best of breed names. If anything, a portfolio, as the bear market continues, should continue to shrink, because as your absolute best of breed names like Apple that randomly sold off 5% yesterday, that becomes more and more attractive. So, you start getting out of other things to focus really in on things. I have started shedding some bonds for folks to be able to focus more on equities. So that's the overall strategy, and that's where we are for the market right now.
Next, Disney stock is in the red this morning after the company reported earnings. Is Disney stock a buy, sell, or hold?
Well, Goldman Sachs says it's a buy. I'd have to say it's a hold. I'm not sure I can just hop in and buy Disney right now. They had decent earnings across the board. Remember, Disney's involved in all kinds of things. They have their streaming services, the parks, the merchandise, ESPN. Lots of shots on goal, is like some people like to say. Arguably, they could split up and all those things would be profitable, except for probably ESPN. I think that one would be tough for it to stand alone without being subsidized by the rest of Disney. But, you have what's going on in Asia. It doesn't make the news cycle over here too often. But again, Asia is really cracking down on COVID, right? They have lockdowns and tens of millions. We're not doing that here, but they're doing it there, and it's affecting their economy as a whole. It's also affecting, of course, the U.S. Companies that have exposure over there. So a lot going on with Disney, a lot of moving parts. I would say just hold it and wait. When you look at a valuation perspective, I checked the PE this morning to see if it was somewhat reasonable. So here's your chart. Let's just go 1 year. to kind of show you the pain that's going on. So from 180, 100, you would think right that would make it a buy. Well, hold that thought. It's a 61 PE. So it's kind of it's not I mean, that's cheap for Disney traditionally for sure. But am I getting excited about that right now? No, I'm not. I think there's a little too much risk out there for Disney right now. So overall, Allison, I would say if you have it, you can hold it, but I would not rush to go out and buy Disney right now.
Last, Social Security experts are projecting next year's cost of living adjustment to be 8.6%. What are your thoughts on this?
Yeah, the good old COLA, right? So, I'm 52, so I'm not like knocking on the door of Social Security. And I know that a lot of people immediately, even my age, or all ages, I guess, say, well, Social Security won't be there when I'm that age. It will be. I think some changes need to be made, and things like this won't help. Now, what it will help with is, keeping pace. Obviously, 62 is the earliest you can collect Social Security unless you have a disability or something like that. But for most people, 62 to 70 is the window. Full retirement age, anywhere from 65 to 67, depending on age. And yeah, if you're collecting Social Security, then you get this cost of living adjustment every year. It's tied to the CPIW. This is a pretty good article. If you just Google 2023 COLA, you'll see many hits that are to the same kind of article out there today. But yeah, it gets adjusted by the CPIW, which is the urban wage earners and clerical workers. Some people argue that's not the best CPI to use, but it is what it is. Last year was 5.9%, which was the highest in 40 years at 5.9. Yeah, we're definitely going to be above 5.9 this year for that adjustment. And again, the experts here are projecting 8.6. There's not judgment put into this. It just is what it is based off the CPI number. So that's kind of nice, politicians in there affecting it. So two things. Good if you're in retirement and you're losing purchasing power out to inflation. The article will state, I don't know this, the article states that the retirees are hit extra hard by inflation. I'd have to see the math on that to see why they're saying that, why it would be different, the restaurants they eat at versus the ones I eat at, right? So I don't know, but I don't see what their point is, but it's going to help those that's either their sole or primary source of income. The downside is when you think back to the country, and the country being the US, is we already have a math problem with Social Security benefits running out in the not too distant future. It used to be in the distant future. I think it's like a decade out now. This obviously, you raise your distributions 8.6% across the board, and you're crushing the math problem, right? You're bringing the run out of money situation earlier, which means politicians will have to act. People are like, well, what's going to happen? And it's like, well, they'll either delay the ages, reduce the benefits, increase the amount that you put in to Social Security. All those are levers that will likely, I think all of those will probably get pulled a little bit as they rewicker Social Security, but I do think it will be there in retirement for folks. But if you would think interesting, if you go back to the 80s and look at the cost of living adjustments, which were the previous highest, there were several in a row that were in, that 7-8%. So it could get a lot more expensive out there for the U.S. government. But overall, Allison, 2023, this thing should be announced in October as to what the actual number will be. And of course, it'll take effect January 1st of next year.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.